Gentlemen, good day and welcome to Lloyds Metals and Energy Limited Q3 FY26 earnings conference call hosted by Anand Rathi Share and Stock Brokers Limited. As a reminder, all participants' line will be in listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Parthiv Jhonsa from Anand Rathi Share and Stock Brokers Limited. Thank you and over to you.
Thank you, Ikra. Good evening, everyone, and thank you for joining us today. We at Anand Rathi are pleased to host Lloyds Metal and Energy Limited Q3 and 9-month FY26 earnings conference call. We have with us today from the management, Mr. Rajesh Gupta, Sir, Managing Director, Mr. Riaz Sheikh, CFO, and Mr. Chintan Mehta, CIO. Without further ado, I would now like to invite Mr. Rajesh Gupta, Sir, to initiate the proceedings for the call, which would then be followed by question and answer session. Thank you, and over to you, sir.
Good evening, everyone, and a warm welcome to all the participants. Thank you, Parthiv and Anand Rathi, for hosting this call. We truly appreciate the interest and time from all our investors, analysts, and stakeholders. Let me start with the headline numbers before we go to the operative narrative, where we have got the highest 11,000 crore rupees we have crossed in consolidated revenue, which is a very, very significant milestone for us. And as you might have seen the presentation, the EBITDA and the PAT match that. I would like to express that this current bottom line was our top line around 2 to 3 years back, and we hope to achieve the same in the future as well. I will take a small deviation from my usual remarks today on the ferrous side and start with copper. Copper, as we know, is the new gold for the new age economy. Structurally, the world is entering a phase where copper demand will remain strong for decades, while supply will remain constrained. And this is where we believe our entry timing is right. The copper project in the DRC, Democratic Republic of Congo, in the Katanga area, will mark a very important milestone in our history. When we expanded our operations in Gadchiroli, the region was considered difficult and impossible, and we ourselves had failed in execution, where we have now learnt a lot. The market as well as the local communities have appreciated the effort that we have put in developing the economy and therefore our business. And we generally believe that over time the same narrative will emerge for Congo Katanga as well as other parts of the world. For this, I would also like to take a moment to acknowledge the leader of the Congo team, Mr. Surya Narayan, as who is the leader and the director of the Congo team. Projects of this nature require not just capital, but deep operational leadership, which we already have with Mr. Surya as well as other core colleagues from other parts of the operations. Now let me come back to the ferrous operations. Execution continues at a breathtaking pace. Multiple projects are progressing simultaneously and most importantly on schedule. The second pellet plant is now expected to be commissioned in Q2 FY27 and the 1.2 million ton wire rod mill by Q4 FY27. While operating our pellet plant, we are seeing an opportunity to unlock latent capacities and optimizing similarly for our pellet plant number 2. We will increase the capacities of both these plants by 10 million tons to 10 million tons from earlier 8 million tons. These projects will improve our value-added mix and enhance margin stability. Logistics remains one of our most critical pillars of our cost leadership. Our first 85-kilometer pipeline is running smoothly and has led us to plan our second slurry pipeline from Hedri to Chandrapur. The key change is the introduction of a stockyard in Chandrapur to move beneficiated ore also through the pipeline route. This will give us advantage for direct access to railways near Chandrapur and also obviously a saving of 850 rupees for the sale material and around further 250 rupees, that is around 1250 rupees for the material that will be used for the pellet plant in Chandrapur. We are by this removing the inefficiency of the mine which doesn't have a railhead. Details of this plan are covered in the presentation. Coming to operational performance, iron ore dispatches have grown meaningfully, supported by the slurry pipeline which is working very well, very strong operational discipline and strong execution. Pellet plants we have achieved within 3-4 months of commissioning optimal utilization and are now looking at debottlenecking it. Our DRI plants, both of which are commissioned, and the power plants are operating at optimized levels and contributing steadily in a very difficult environment of DRI. On the demand side, both iron ore and pellets have witnessed strong demand in the domestic as well as international markets, and product has been very, very well accepted. We expect the buoyancy of the market to continue, supported by infrastructure, steel demand, and of course the economic growth in the country. Let me spend a few moments of time on the MOU with Tata Steel. We have signed a non-binding MOU with Tata for multiple collaboration to strengthen the ecosystem in the Gadchiroli area, in the eastern belt of India, and of course we have also signed a shareholder agreement for BRPL pellet plant along with a conversion pellet agreement which gives us a steady cash flow in BRPL. To summarize, we remain very buoyant on our ferrous operations. Iron ore volumes are expected in line with the EC to grow in Q4 as well as FY27, and value addition plans continue, and FY27 will mark our formal entry into steel making. And lastly but not the least, copper will act as a strong growth engine over the medium term. Now I hand over the call to Riyazi and Naredi ji, who will take you through the detailed figures.
Thank you, Rajesh ji. Good evening, everyone. I'll start with a quote that we strongly relate to at Lloyds Metals. As Satya Nadella says, growth is not just about size, it's about mindset, learning and execution. This philosophy resonates very well with what we are seeing in our business today. Scaling responsibly, improving structurally and executing with discipline. With that context, I will take you through the standalone financials and operating performance for Q3 and the 9 months ended FY26, focusing on numbers, margins and capex. This has been a very strong quarter and 9-month period for us on a standalone basis. In fact, Q3 and 9-month FY26 are the best we have seen so far in terms of revenue, profitability and margins. Q3 FY26 standalone, the total income came in at about 3,875 crores, up 129% year-on-year. EBITDA was 1,317 crores, which is a 137% year-on-year increase. PAT stood at 889 crores, up 128% year-on-year. For the 9-month FY26 standalone, the total income was 8859 crores, up 59% year-on-year. EBITDA came in at 2994 crores, a 74% year-on-year growth. PAT was 2129 crore, up 71% year-on-year. With regards to the margins have remained very healthy and stable. Q3 EBITDA margin was about 34%. 9 months EBITDA margin stood at roughly 33.8%, which is almost 280 basis points higher year-on-year. This improvement is not one-off, it's structural and is coming from higher share of value-added products, especially pellets, benefit of the slurry pipeline, which has started flowing into the P&L, better utilization across mining, pellet and DRI operations. Operational highlights. On the operational side, Iron ore production was 5.49 million tons in quarter 3 and 12.87 million tons for 9 months FY26. Dispatches were largely in line, which is 4.1 million tons in quarter 3 and 10.1 million tons for the 9 months. EBITDA stood at 1825 per ton in quarter 3 and 1951 per ton for 9 months FY26. Pellets have been a key positive this year. Pellets production was 1.14 million tons in quarter 3 and 1.95 million tons for 9 months FY26. What's encouraging is that this run rate was achieved within just 3 to 4 months of commissioning. Realization in quarter 3 was about 10,289 per ton, and whereas EBITDA per ton was roughly 4,535, supported by captive iron ore, slurry-based evacuation and strong domestic demand. DRI volumes were around 0.12 million tons in quarter 3 and 0.29 million tons for the 9 months. DRI expansion was commissioned during quarter 3 and operations are now stabilizing. Value-added mix. Value-added products are now forming a meaningful part of our revenue mix. For 9 months FY26, value-added products accounted for roughly 35% of standalone revenues. This mix shift is central to improving margin stability, reducing volatility, and enhancing overall return metrics. Now, coming to the CAPEX update on a standalone basis, let me quickly touch upon CAPEX. Standalone CAPEX during 9 months FY26 was about 4,236 crores. This was largely towards pellet plant 2 DRI expansion, the 1.2 million ton steel plant at Chandrapur, the first module of the beneficiation plant. Importantly, CAPEX execution is on track and within approved budgets. Touching upon the balance sheet and cash flow, despite the high level of CAPEX, the balance sheet remains comfortable. Strong EBITDA generation has supported internal accrual-led funding and controlled leverage. Working capital continues to be well managed, helped by faster dispatch cycles and healthy demand conditions. The outlook looking ahead, iron ore volume should remain strong in quarter 4 FY26. We aim to exit FY26 with 20 plus million tons volume on ore. Pellet operation will continue to run at optimal utilization. DRI contribution will improve further as operations stabilize. Overall, we expect margins to remain robust, supported by a value-added mix and ongoing logistic efficiencies. To sum up, standalone performance in quarter 3 and 9 months FY26 has been very strong. Margins are holding up well on structural basis. CAPEX execution remains disciplined. With that, I'll hand it to Naredi ji for Triveni performance.
Thank you, Rajesh ji and Riyaz ji. Good evening, everyone. So, Triveni growth has always been about disciplined execution, consistency, and doing the fundamentals right, day in and day out. Let me take you through the Triveni's performance for Q3 and the 9 months ending FY26. From a financial perspective, this has been a strong and improving period for Triveni. In Q3 FY26, the total income stood at about 2,200 crore with EBITDA of roughly 550 crore, translating into an EBITDA margin of close to 25%. For the 9 months, revenue were around 5,480 crores with EBITDA of approximately 1,080 crores and margin of about 20%. The improvement in margin reflects better operating leverage, higher equipment utilization, and continued focus on cost discipline across various projects. Operationally, our coal mining operations continue to perform exceptionally well. At PB West, we achieved the highest distinction of a 5-star rating from the Ministry of Coal, ranking number 1 among more than 380 open cast mines in the country. December saw a record monthly coal production of 17.7 lakh tons, and the in-pit crushing and conveying system commissioned earlier has already handled close to 15 lakh tons, significantly improving the efficiency. PB Northwest, another coal block, has also commenced production and dispatches, and we expect this project to scale meaningfully over the next few quarters. Odisha remains a key growth driver for us. Several mines have seen capacity enhancements, and overall, Odisha volumes are expected to grow by nearly 40% year-on-year in FY27. This scale-up is being driven by faster statutory clearances, improved infrastructure, and focused execution at site. In Gadchiroli, which many of you are familiar with, the environmental clearance has been increased from 10 million tons to 55 million tons, including BHQ. Alongside scale, we continue to push sustainability-led initiatives such as electrification of mining equipment and LNG hybrid deployment, which are helping us optimize costs while reducing our carbon footprint. We have commenced MDO and exploration activities at Geomesur India Private Limited from January 26. This is a gold mine. This asset provides long-term visibility with a targeted EBITDA of contribution of around 60 crores in FY27. Sorry. And we see potential upside as exploration progresses. Internationally, we are rationalizing lower margin operations in Indonesia and redeploying our equipment to higher return opportunities. Overall, Triveni's focus remains very clear: scale responsibly, execute efficiently, and protect margins through productivity and cost optimization. The pipeline for FY27 looks very strong, and we are confident of sustaining both growth and profitability. With that, I'll hand it over to Mr. Parthiv, who can open the floor for question and answer. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amit Dixit from GS Financial. Please go ahead.
Yeah, hi. Good evening, everyone, and thanks for the opportunity. Congratulations for a very good set of numbers. Couple of questions from my side. The first one is on the MOU that we have with Tata Steel. So just wanted to understand, the various facets of this MOU. While you have explained in your prepared remarks, Tata Steel also held a Concall in which they explained few things. But just wondering, that in mining, when we are so strong in this region, why do we need someone else? I mean, it might be Tata Steel, of course, no doubt they're experts, but what expertise we are actually looking to get from Tata Steel? And is there something that goes beyond mining, let us say into steel, where we might get some, kind of consultation from them? And if there is any scope of having a long-term iron ore supply agreement to them? Just wanted to explore these points.
Thank you, Amit. The MOU with Tata has two parts. One is the BRPL SHA and the BRPL ownership and conversion contract, which is executed. The second, future exploration of opportunities. There are two areas that we are looking at. One is the eastern area of the country, where, for example, Tata may have some assets where we can act as a contractor, as an MDO contractor maybe, or where they may need a pipeline to a certain area where we have some expertise which Tata has not yet developed, maybe we have some land in Paradeep which we can try to utilize in a better way. A lot of opportunities have been looked at in the eastern belt. In the Gadchiroli area, we are looking at whether we can bid jointly or opportunities come up with government trending system where we can get ore at a relatively better pricing, better commercials. This would not be from the existing mine. It will be for future expansions. We are always open to partnerships because that is the way to develop fast, and Tata is one of the finest companies in the country. Not one of the, I would call them the finest company in the country. So definitely it's an honor to be partnered with them.
Okay, great. The second question is essentially on the copper. So, it is indicated in the presentation that there are certain mines also associated with it. First of all, Congo is not exactly the best place to work. And then, mining, I know several companies who have failed because of various reasons. So what is it that we see in Congo, and are these mines yet operational, or at what stage of exploration they are? You have indicated some numbers, but these numbers seem to be more for the processing side. I just wanted to understand the backward integration part of it a little bit more. And if you can also mention the grade of copper that you expect over there.
We are looking at Democratic Republic of Congo, Katanga area. This area by itself and DRC by itself is the second largest producer of copper in the world at the moment after Chile, number one. Number two, the copper majors, Glencore, etc. are all based in copper. In this area, there are 60 to 80 companies, small and big, operating, and the infrastructure, the systems are there in place to take care of very many things. The political stability in this country is much better, and particularly this part of the southern part of the area, and it's a very economically based country and area, not politically worrying. Not zero politically worrying. There would be some worries obviously, but it is well sustained. The mining leases that we have are 16 or 18 leases. I'm forgetting the number right now. 18 leases over 100 square kilometers. 16 leases over 100 square kilometers. Exploration is going on. We already found copper at good depths. 1.5 to 2% copper is also available, 0.8% is also available, oxides are available, and the 10 to 12,000 tons is a direct output of the plant that we are talking. We can, for the cathode plant, leaching and cathode plant, we could take the ore from our own mines, which we already started accumulating, as well as from bought-out mines. At the end of the day, it would be an integrated operation of around 30,000 tons per annum, which may take 2-3 years to achieve. We believe that in the next year, financial year 27, 10,000 tons of operation will be achieved at a fairly integrated mix of ore.
Great, sir. Just if I can squeeze one more. Just wanted to get the status of BHQ plant.
BHQ plant, the land is under land procurement is under control, and the engineering is complete. The ordering is complete. We have ordered the equipment on the best possible companies in the world to take care of any exigencies, because it's a new technology in India, so we've not taken any chances on the technology part of it. We have worked with the Chinese and now with FL Cement also, and we are hopeful of getting it commissioned by December 27 or so.
Okay, great, sir.
Latest by that time. And yeah.
Okay, sir. Great. Thank you so much, and all the best.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Jashandeep Singh Chadha from Nomura. Please go ahead.
Hello. Hi. Thank you for the opportunity, and congratulations, sir, on a great set of numbers. My first set of questions are around iron ore. Firstly, on your guidance, FY26 guidance is close to 20 to 22 million ton. If I assume that you will be doing 3 million ton of pellets also, that is close to 4.5, 5 million ton of iron ore. 10 million tons of iron ore you have still done, which means close to 6 to 8 million tons of volumes you are forecasting for fourth quarter of FY26. Lloyds has not done any time, such volumes in one quarter. Just wanted to understand what is the confidence, behind giving such guidance and what are the challenges that the company can face in meeting those guidance. My first question is this, sir.
The volume in this year, in this month, that is January, is around 2.4 million tons. 2.5 million tons, which crosses the 26 million ton overall and definitely will achieve the 20 to 21 million ton target for the year. We have to appreciate one thing, that at the moment we have to, the problem is not in the marketing of it, the problem is not in the mining of it, the area that we are right now focusing on solving the problems are on the logistics side. Right now we are moving around on an annualized basis around 4.5 million tons of ore by the pipeline, and come by April we'll be able to do 9 million tons. The second plant will come by June. The second pipeline, the pipeline will be ready to take the second pellet plant input. So 9 million ton would move out of that. And right now we are producing around transporting by truck around 70-60% more than the overall requirement. It is a tough job. We are very confident of achieving 21. That's why we give a confident guidance of 20 to 22 million tons for the year. We believe that quarter guidances and directions are lesser. Quarter guidances are lesser important for a company of our nature, and our overall direction of decadal growth or at least 3-year growth is what I am focusing on. Operational efficiencies are looked at every level, and you can see that in the increase in the revenue, in the margin also. 280 basis point is a factor of whatever Riyaz said, plus a cost control system also. So everything has been factored in when we have made the guidance.
Understood, sir, and thank you so much for such an elaborate answer. My second question is also around, iron ore only. Sir, we have seen that the benchmark domestic iron ore prices have come down in this quarter. With that regard, I just wanted to understand how much, the realization has been impacted for Lloyds, and how much, margin compression, EBITDA compression we can see, in the fourth quarter. And then related to iron ore only, I just wanted to understand what is the capex for the slurry pipeline, and can you also, for our analysis, can you also, tell us how does it compare with the peers?
Compared to the
peers, sir, your peers.
Yes, from other companies.
Okay, the benchmark has come down, and so has the basis of benchmark come down from 62 to 61%. So if you currently look at benchmark price of $103, it amounts to around $108, which is around $3-4 higher than the same amount last year, same period last year. So I think the benchmark has not really come down; it's gone up.
So domestic. I was talking about domestic iron ore.
Domestic iron ore, I don't know by what stage you are saying it's come down. Some of my competition has increased the prices over the last 2 months, both the months. The auctions that have come out have been very strong. Steel benchmark is very strong. So at the moment, I do not see any indication of the steel industry or iron ore industry being soft in India at all. At the moment, maybe 1 month back, 1.5 months back, it was different, but that's part of the cyclical nature of the business.
And sir, on slurry pipeline, the capex and...
Sorry to interrupt you, Mr. Singh. Can you rejoin the queue for more questions?
It's part of my question only. I've asked you that.
On slurry pipeline.
On the slurry pipeline, as you might be knowing, we had planned for another 5 million tons of a slurry pipeline connecting our the mines to the Chandrapur plant Gugus plant in Chandrapur. Now, what we are now doing is we've increased the capacity of that. We will be now making it as a 16 million ton slurry pipeline, so that we cover the entire 26 million tons of dispatches through slurry pipeline. So it will be one is existing, which is there as a 10 million tons. This is the second slurry pipeline, which will be a 16 million ton slurry pipeline, which will be taking us more to the market as well as to the to our Chandrapur plant. And the total cost for this, we also in fact have a second phase on it, the slurry pipeline, which will be connecting to more of the markets as well as the ports. So the total cost in Visage is around 8,000 crore rupees on this particular project, but we will be doing it on phase basis. So the first phase of up to Chandrapur will be around 2,000 crore rupees, 2,500 crore rupees.
Thank you so much, sir. I'll turn back to you.
Thank you. Ladies and gentlemen, you are requested to limit your questions to 2 per participant. The next question is from the line of Prateek Singh from IIFL Capital. Please go ahead.
Hi, thanks for the opportunity and congrats on a good set of numbers. The first question, Guptaji, is largely on BHQ project. Given the fact that bulk of our volumes going ahead would be coming from BHQ, how confident are we in maintaining the fact that the cost of production of BHQ would be similar to our current cost of production? Given that we'll have to mine more material, there will be beneficiation cost also. I understand that we save a bit on royalty, but do you think there is any risk of operating cost overrun in BHQ going ahead?
BHQ, the royalty saving based on the existing proposals of the government as well as existing policies as well as future proposals of the government, the royalty savings would offset the cost of processing the ore, the BHQ2 ore. Please also factor in that the grade of ore from 62-64 would come 66-67%. And that gets a very high premium. So the cost of ore versus the selling price or the usability of ore becomes much better. The BHQ beneficiation of ore in general has been accepted by the government as a very, very important aspect of the national policy of steel, and that therefore we expect a lot of support on the royalty front from that. Does that answer your question?
Yeah, so just going into a bit more detail here, sir. So royalty, if our current realizations are, let's say, 6,000 and royalty all in, let's say, 20%, so 1,200 odd royalty, and even if royalty on BHQ is, let's say, 0, so 1,200 rupees per ton of saving plus, let's say, some premium because of higher...
Royalty is not 0. Royalty will be around, from 1,200 will come down to around 200 rupees. And processing of the ore would involve some power, which is the biggest cost. We are working on greening our power also, as well as other operations, and that's what I said, we are using the best technology to ensure that the systems are very, very strong and uptimes and efficiency of the plant is the best.
Okay.
The premium that we would get on this output of product, if I were to sell all the ore, would be around 1,400 rupees a ton also. You have to also factor that in.
Understood, sir. Understood. And the second question is largely on the slurry pipeline, 85 kilometers.
Sorry to interrupt you, Mr. Singh. As we have a long queue, can you please rejoin for a follow-up question?
Yeah, sure.
Thank you. The next question is from the line of Vikas Singh from ICICI Securities. Please go ahead.
Thank you for the opportunity. So my first question pertains to our copper mine. As you stated that it was an operational mine, so just wanted to understand, had the existing promoters was facing any difficulty in terms of producing and ramping up of the mine, and that's why we got the chance to get some stake there. And secondly, on the management bandwidth, we are doing too many things simultaneously. So just wanted to understand the management bandwidth in terms of managing and looking after the timely completion of all these projects. How should we look at it?
Number one, on the existing promoter, they are more involved in commercial activities and general traders in the country. They have got this mine as an opportunity. Mine and the copper plant has been set up by them as well. The copper plant is running, is set up but not running. They lost the bandwidth to run it, and that's where we come in. We have Mr. Prabhakaran and the erstwhile Triveni had been looking at DRC for a long period, and that's how the opportunity comes to us of investing in that. There have been no problems. Again, I repeat, there are around 70-80 plants, including Glencore and Ivanhoe and the best companies in the world running copper mines there and copper operations. So that's not a worry that we foresee in a very serious way. In terms of operational bandwidth, we have scaled up. Let me give you a little bit of history. We scaled up from around 500 crores to 10,000 crore rupees, or in this year maybe 30,000 crore rupees over 4 years. We have proved to the market, we have proved to ourselves, we have proved to our team, and our team has proved to us that we can take care of growth in a sustainable, sensible, economical, and business-like manner. And we continue to do that, number one. Number two, as far as Congo particularly is concerned, one of the promoter directors would be involved full-time there, apart from a very, very professional team who has been involved in mining operations, and we have had experts on copper side also, on the copper manufacturing side also. The technicality of the leaching process and the cathode process is not a super technical or a super new invention, and that can be taken care of by the team that we have ensured are already on the job at the site as we speak. I think that should we are confident of sustaining this growth in a very sensible way.
Noted, sir. So second question pertains to Triveni. While the top line growth
Mr. Singh, sorry to interrupt you. As we have a very long queue, can you please rejoin for a follow-up question? Thank you. The next question is from the line of Vedant Sarda from Nirmal Bang Securities Private Limited. Please go ahead.
Thank you for the opportunity and congratulations on the great set of numbers. Sir, my question is, we are hearing that government is taking various measures to ensure availability of iron ore. Like they have to bring our iron products prices at par with international markets, so we can compete and export iron goods. So can you comment on the pricing outlook going forward and how to look at this?
See, if you look at iron ore in India, the growth is around 5-6%. The steel growth is around 8-9% even now. If you look at 5 years CAGR, it is 5-6% for iron ore and around 9-10% for iron ore. So there has been a continuous shrinkage of the supply, extra supply, and therefore exports either in the form of low-grade iron ore or in the form of pellets have reduced. So the overall supply-demand gap is very, very favorable in supply of iron ore. Number one. Number two, as we go forward, over the next 5 years, around 1/3 of the capacity which is premium-free will go into auction over the next 5 years, and that will add to the, not the lesser supply, but definitely to a higher cost mechanism for the industry. So we are pretty confident of our commercial part of selling iron ore, and over a period, our value-added business will be quite a lot, and we can therefore be well equalized in both iron ore as well as value-added products like pellets or steel as well in the future.
Thank you for explanation, sir. Thank you so much.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your question to one per participant. If you have a follow-up question, you may rejoin the queue. The next question is from the line of Harsh Shah from Seven Rivers Holding. Please go ahead.
Hello. Yeah, good afternoon, sir, and our heartiest appreciation for excellent execution over the last 3 years. So my first question is on the MOU with Tata Steel. Given that it could end up being quite an extensive agreement eventually, so will it in any way affect or change our plans for the integrated steel plant, which would be our 16,000 crore capex plan?
Our future steel plant in Gadchiroli is being looked at internally, nothing to do with the Tata MOU. Any Tata MOU, any Tata set up together would be for a different plant than that.
Okay. And sir, one bookkeeping question. What would be the warrants outstanding now as of today?
What is the?
Outstanding warrants as of today.
We should be getting around 900 crore rupees from it. I'll give you not the number, but the value around 900 crore rupees is pending, which should be coming up in the month of March. That is something between 15th or 18th March. That's the last date. So we should be getting.
Okay. And for on the copper part, the 10,000 metric ton capacity which we have, what would be the average realization and EBITDA margin on those?
This is copper cathode, so the current copper price is around $11,000, $11,500, $12,000, and normally there's a premium to Congo because of the transport cost. So the EBIT, that's the approximate range, and the margins that we anticipate are approximately 32%. So that gives that 500-700 crore rupees that we're talking about next year.
Okay, and since we have 50% stake in this, it is relating to this. So, are we the MDO partner here, or mining will be done by someone else?
Hello.
Mining will be by Triveni, by a subsidiary of Triveni in that area. Yes.
Okay, sure. Thank you so much.
Thank you. The next question is from the line of Hardik Gori from Abans Investment Managers. Please go ahead.
Hello, sir. Thank you for the opportunity and congratulations on a great set of numbers. Firstly, on the growth outlook for our MDO business in FY27, and secondly, what was the IPS benefit for Q3?
IPS benefits, we have been drawing the benefits from day one of the pellet plant production, and this year has been around 130 crore rupees. The Triveni outlook is around 40% increase in iron ore, non-Lloyds metal. Around 60%, 70% increase in the Lloyds metal because of the BHQ increase. 15% in NTPC, that is both the Pakarbadi mines. Around 60 crore rupees EBITDA, they have come up directly with the EBITDA figure expected for the gold mine. Not
Gold mine, 0.3 million tons.
0.3 million tons output, and that would be the profitability. There will be some reduction in volumes in Indonesia and in the barite operations. Overall, a top line growth of around 15 to 20%. And a bottom line growth of around 35%, right?
Got it, sir. And our expected debt trajectory on a consol level?
Sorry to interrupt. Please rejoin the queue for more questions.
All right, thanks.
Thank you. The next question is from the line of Vineet Thakur from Plus 91 AMC. Please go ahead.
Hi, good evening, sir. Thank you for the opportunity. Sir, I would like to know what would be the expected debt consol figure for the year and what would be our peak debt?
As on 31st December, if I would say, the consolidated net debt was around 7,100 crores. This year, we should be not more than that. And FY28 is when I would say the peak debt. When we reach the peak debt, we should be on the consol basis should be around 10,500, 600 crore rupees. So we are always targeting at 1:1 debt to EBITDA, and that is what we are working on. That's it.
Thank you, sir.
Thank you. The next question is from the line of Shubham Harne from Purnartha Investment Advisors. Please go ahead.
Hi, sir. Thank you for the opportunity. The question was, I think EBITDA per ton for pellets has declined on a Q-on-Q basis. Last quarter it was 5,000 per ton. This quarter little less, around 4,000 or so. So any reason for that?
DRI is one of the most challenging businesses, like some other questioner asked earlier about the down cycle. It's most affecting the secondary steel market and that. Prices on pellets, if you're asking, it's gone up.
No. Prices is
the EBITDA per pellets.
If you look at the pellet prices,
yeah,
the pellet pricing has gone up. Therefore, spawn end pricing is showing that there's a pressure on that, right? EBITDA on DRI pricing. So basically, it was a cycle. The cycle has crossed the hump.
The pellet prices in Q2 was around 11,000, what we had got an average realization, and it has come down to 10,000 in Q3. That is why the margins have been reduced.
The pricing is lower because we have added more export to the mix.
Okay.
As the volume has picked up, we have had to add some volume of export. The EBITDA is still very strong and much stronger than the rest of the industry put together.
Okay. Got it. Thank you so much.
Thank you. The next question is from the line of Tanmay Chaudhary from Ventura Securities. Please go ahead.
Hi, sir. Thank you for the opportunity. So, given Lloyds' ongoing capex plan pipeline, so can you just outline the expected funding mix and cash outflows over next 2 years, and also the scheduled debt repayments and RTS repayment, and providing TMPL not declared any dividend?
The debt schedule and all, we can give it to you separately. I won't be able to do that. But yes, the capex outlay is around 14,000 crores, including from this year and the next year. We would be around we intend to around 6,000 crore rupees from debt, and then the balance should be from the internal accruals. That is where we are.
Okay. And sir, just last one question. In PPT, we have mentioned the realization of pellet increases because of the geographical location. So can you just throw some light on it?
Sorry, can you repeat your question?
I'm saying in the PPT we have mentioned the realization of pellets increases because of the geographic location. So can you just throw some light on it?
Geographically, I mean, I cannot relate directly to the PPT question, but geographically our location is such that we can market to, we have been very strong in marketing to the south as well as the Chandrapur area itself. So that's why our realization in pellet is around 4,500, 10,000, and the EBITDA is around 4,500, 5,000 rupees per ton because of the market-friendly nature as well as our costing and logistics cost. So I think that's where, does that answer your question or is there something specific?
No, sir, like I'm asking about the realization.
The realization is a factor of trade versus market, and that's where we are.
Being centrally located, it helps. The location helps. That's how we are better than others. That's the only reason.
Okay, thank you.
Thank you. The next question. Thank you. The next question is from the line of Karthik Srinivas from Unifi Mutual Fund. Please go ahead.
Thanks for the opportunity. So I just had one question, just on the policy level. Now that many mines are coming up for auction till 2030, and there is significant demand-supply gap between iron ore and steel, is there any possibility that the government has to intervene and put a cap on the auction premiums? And is there a risk that we run because the government will intervene and put this thing on the auction premiums or change some of the policies at the policy front?
The government, we believe, is still believing in free market, and the premiums are quoted by the biggest consumers of iron ore, which are some of the biggest corporates in the country. So we have not seen any policy change or policy announcement which would indicate that there is being a cap on the premiums being put.
Okay.
Thank you. The next question we have is from a follow-up question from Jashandeep Singh Chadda from Nomura. Please go ahead.
Hi, thank you for the opportunity again. Sir, my question was regarding Triveni. Just wanted to understand, on the remarkable performance, the EBITDA has doubled quarter on quarter. I wanted to understand that the proportion of the EBITDA. So is it the large chunk of increase, is it coming from increased volumes from Lloyds, or there are other major heads also because of which the EBITDA has improved? And wanted to understand how should we model the growth in EBITDA going forward till FY28 if you can help us.
In Q3 the EBITDA is increased mainly up to Q2 due to rains and other local factors. The production was lower, so the EBITDA was lower. And Q3, when the rains were not there, we came to our original strike rate, and the EBITDA was normal as what we had planned. And for the next year, what we are targeting, Q4 again the Lloyds will be doing the full production. This year also we are in Q4 we are starting one new mining lease, and next year we are getting 3-4 new contracts and extended capacity, so the volumes will be higher, and accordingly we don't see any challenge in EBITDA.
Understood, sir. So just confusing that, so this appears to be the normal run rate for EBITDA, and as contracts increase and volume increase, there will be growth from here on. Is my understanding right, sir?
Yeah.
Okay. Thank you so much, sir. Thank you.
Thank you. The next question is from the line of Rushabh Dhruv from Uttam Investments. Please go ahead.
Yeah, hi, am I audible?
Yes.
Yeah, so my question is regarding iron ore sales volume. So for this quarter, we just did around 4.1 million tons, right? Then why is this PPT also showing 5.39 million tons? What's the difference here?
That also includes the internal transfers. That's how it was. That is the dispatches from the mines.
Okay. So it's captive, right?
The sales figure is 4.1 million, which is there.
Sales is 4.1. Okay. Thank you.
Thank you. The next question is from the line of Prateek Singh from IIFL Capital. Please go ahead.
Hi, thanks for the opportunity again. Just wanted to get a sense as to when we had showcased the transaction with Triveni back in December 24, we had given a sense of an EBITDA of around 3,500 crores in FY27 by Triveni. Is that something which we stand by or are on track right now as well, or is that number a bit changed up or down?
In FY27, the EBITDA of Triveni should be close to 3,000 crores.
Understood. Thanks. That's all from my side.
Thank you. The next question is from the line of Divya Agrawal from Fincom Family Office. Please go ahead.
Yeah, hi, sir. Thanks for taking my question. So, sir, my question is on Triveni MDO business. So, in Q2 call, you guided to achieve EBITDA of around 2,000 to 2,200 crores for FY26. However, if we see 9 months, the total EBITDA stands at around 1100 crores. So do you still stick to your earlier guidance, or would you like to revise it downwards?
We stick to the guidance.
Yes. You stick to the guidance, sir?
Yes, we stick to the guidance.
Okay. And on the revenue guidance as well, so just wanted to know for FY26 and 27, what would be the revenue guidance for Triveni?
FY26
and 27 for the entire year FY26 and entire year FY27.
FY26 and FY27.
Right, sir.
Yeah, so FY26 we are looking at the revenue guidance of around 7,500 plus crores, and FY27 revenue guidance of 10,000 plus.
10,000 plus crores.
Yeah.
And lastly, sir, just what would be the actual PAT for...
Sorry to interrupt you, Mr. Agarwal. Please rejoin the queue for more questions.
Sure. Thanks.
Thank you. We'll take the next question from the line of Parthiv Jonsa from Anand Rathi Share and Stock Brokers Limited. Please go ahead.
Hi, thank you for the opportunity and thank you for allowing us to host the call. So my quick question is on Triveni MDO. A couple of quarters back, you had given us the guidance for almost up to 28 and 29. I believe Sir has given the EBITDA guidance of about 30% in 27. Thereafter, is it possible to give a guidance of 28 and 29? Because I think it was about 32% give or take. Considering you are going to do 40% higher volumes in iron ore, non-Lloyds, and for the other minerals as well, is it possible to give some guidance?
28, 29. See, it's a contracting company. We are looking at contracts on a continuous basis. It will be very difficult to give a further guidance than what we have. Even the guidance that Mr. Naredi just gave would have some surprises upwards because some contracts would come up hopefully in future.
Absolutely, yeah. Okay. And so is it possible to repeat that number, that 40% increase in iron ore and everything? I think I missed a couple of them actually. For next year.
The external iron ore figure is around 40% increase in FY27. The external coal, that is NTPC contract, is around 15% growth. Correct me if I'm wrong, Mr. Reddy. There would be a reduction of around 65% in the barite operations. There would be a reduction of around 25% in the Indonesian operations. Add to that gold and copper of the Tananka area. With that, we expect that to figure that Mr. Naredi just gave us.
Perfect. Sounds great, sir. Thank you, sir.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I would now like to hand the conference over to Mr. Parthiv Jonsa for closing comments. Over to you.
Thank you all for joining us for the conference call today. We at Anand Rathi would like to thank the management for giving us this opportunity. This concludes this conference call. Thank you everyone and have a good day.
Thank you.
Thank you.
On behalf of Anand Rathi Shares and Stock Brokers Limited, that concludes this conference. Thank you for joining us and you may now disconnect your lines.